So here we are again, Mr. Frencel Gillion. For the guests and viewers, Frencel Gillion is no stranger to the corporate boardrooms at senior level in South Africa. He is a CFO, CA, and venture capitalist. And we started last week going through his new book, which is due for release in a few days. It has been available for pre-order. It's still available for pre-order until the 11th of May. And we are going through the book not as a book review, but as a series of lessons that hopefully our viewers / listeners can actually take as lessons for their business. So The Growth Illusion, which is the book, is a very insightful book based on, Frencel, your journey to where you are today, having been a corporate man, now founder, and where you are helping other founders to not only realize, but build value in their businesses. And what to me is so useful and interesting is that you are able to look at businesses as an investor, as a venture capitalist, and you're going to say, this is what I look for. And reading the book, as you have shared with me, this ability to sit on both sides of this fence and have this overall view of the picture is one of the things that makes both you as a person so interesting to speak to, but also the book so interesting because I'm able to read the book as an entrepreneur.
Yeah.
And previously in my career as a banker, and now particularly as a venture capitalist, and look at the book and say, that's why you do this. This is why structure is important. When we looked at chapters 1 and a little bit of chapters 2, we spoke about the 3 paths that a business can take. And the one is growth by default. The one is basically the growth that unravels. And then disciplined value building. What do you call those 3 paths, Gillian? Would you like to very briefly, in sort of 3 minutes, just recap on that concept for us? Because they are the foundation of the book. And I think what I'd like you to do, if you don't mind, is cover those 3 paths and then tell us how the book is structured to lead someone through the path that they should be walking, which is hopefully a disciplined value building.
Yeah. No, thanks, Michael, and thanks for having me. And I think the last conversation was very helpful and useful. So my background, I've worked both in the development finance space where, I was a deal maker, eventually became, chief investment officer for a fund that was focusing on small to medium-sized businesses and also entrepreneurship. Then I also worked in more, let's call it sophisticated environments in corporate finance and investment banking space, and then also private equity. And I think what's common amongst those is that ultimately it's about the entrepreneur. So if you look at the SMEs that I'm speaking about, again, you're backing the entrepreneur. And then also, with private equity, typically, when you do a private equity deal, the private equity investors, they back the entrepreneur. And typically, what would happen often is that if a private equity investor would buy into a business, they'd make an assessment of the management, which oftentimes in the medium-sized companies sector involves a founder. So many of these businesses are founder-led. And that's where my thinking came from. I realized that a lot of focus is on the SME space, getting startups, helping. I think even if you look at South Africa with a large unemployment issue, you find many young people wanting to get into entrepreneurship and maybe not always understanding how difficult it might be. But be that as it may, a lot of focus, incubators, funding packages, and the likes. What I didn't see as I was doing the research on this book, and thinking about, my journey as a coach, I realized not a lot of focus is on this mid-market, the medium-sized companies, and how you transition from having graduated from let's say a small business to a medium-sized company, but how do you harness that value, that growth into value? And I think it's important. I think my thesis is that not all growth leads to a valuable business. And growth is not linear. In other words, it doesn't just continue to grow. And so then I reflected on some of my experiences both in the corporate environment, whether DFI or private equity, and then also as a consultant, right? So if one looks at these three models, they're all reference to experiences that I've had in my career. So if you look at the undisciplined growth, the idea there was a company that has been successful. They're no longer a small business per se. They have some substance, but not necessarily profitable, or there's no predictable profitability. 1 year profits, next year losses, some loss-making divisions. And also, as I mentioned in the book, the business does not generate cash. So for me, one of the key metrics of a successful business is cash generation, because that gives you options. The next one, which I call growth that unravels, my point of reference there are more these larger businesses that I've also either worked in or advised on. And what I found there is that the problem, still linked to the founder, might be a little bit more sophisticated. It becomes more about strategy and strategic choices. In other words, not all the shareholders might have the same vision of the future, which essentially then means the business plateaus, right? And if one looks at anything, if you're not growing, you're going backwards. And so that's typically what happens. The business reaches a stage where it's profitable, it's successful, but it's stagnating and eventually taken over by competition or starts to fragment. Now, the third one, which I called, value building growth, the idea is that those entrepreneurs that built it either from scratch, or it could be a business that's already been around for generations, and now you got maybe second generation leadership. But the idea there is that it doesn't happen by chance. There's a blueprint that these sectors, the third category, actually introduces, and it takes it in disciplines, whether it's strategy, whether it is governance disciplines, and so on, that makes these businesses able to grow sustainably and monetize the growth. In other words, it's something that provides them dividend flows, or they can sell to a private equity investor or to a trade buyer. And that is my vision with the book, is to plant the seed with the reader to say, look, yes, you've done well. You've no longer a small business per se, perhaps, in the medium size, company sector. But what is the next stage of growth, and how do you grow sustainably? And how do you also grow in a manner that allows you to have an asset and not just be trapped in a business, in a job, as it were?
So within that framework, you speak about this evolution of the founder, and we did speak about this in our last chat, but I'd like us to now tie this into one of the case studies that you mentioned,
Mhm.
and I think it's in chapter 2 already, but
Yeah.
it was such an interesting case study because I was not aware of it. But you speak about the fact that the founder needs to move from the doer to the architect, that
Yeah.
design phase, to the steward, which is the sustainability phase, all along the way generating value and free cash flow, which, as you
Yeah.
say, that is the foundation of growth. And I always like to say turnover is vanity,
Yeah.
profit is sanity, and cash flow is reality. And you cannot build cash flow without profit, because
Yeah.
turnover does
Absolutely.
not create sustainable cash flow. So I'd like to look at the Courier Guy case
Mhm.
study, which you mentioned, and it was fascinating. This guy starts this business on 2,000 rands worth of capital back in the year 2000, and he's got his motorbike, and he becomes known as the Courier Guy. And eventually, in 2024, that business is sold for a substantial sum of money. But what is interesting about this to me is not just the fact that it was this small business that grew, that sold. It was the strategic thinking and planning that was necessary along the way to transition all the way and do what so few small businesses are
Yeah.
able to do. And your experience in startups and the venture capital, but particularly the funding of startups more than the VC work, that failure rate is significant, largely due to the founder's inability to make those transitions. So would you like to run through the Courier Guy case study in that framework of doer, architect, steward?
Yeah, no, it's a very interesting, case study. So I came across it again as I did the research. So the founder, so the doer, architect, steward, these are concepts I came up with as I reflected on, what am I grappling with? What are the transitions that the founder needs to make? So one of the points I make in chapter 2 is that the founder is the constraint to creating this business that becomes valuable, where you can create genuine wealth and have an institution. So I'm making the point that one of the constraints then is also around the founder centrality. In other words, in the smaller businesses and even larger businesses, I've seen larger businesses where the founder is still central. So all the decisions, everything goes through the founder, all the approvals needs to go to the founder and so on. And I think that's what the entrepreneur behind the Courier Guy did differently. So he started off essentially almost by accident. I think he was unemployed, living in someone's back room, and then he was asked to deliver something, and that's where the name came from. They were looking for the Courier Guy, and he was the Courier Guy. And so from there, firstly, obviously, a man of excellence, a man of his word, taking, pride in his service, and also identifying a gap. So I think if you look at one of the things I speak about in chapter 3, when I talk about strategy, one of the points I make is that for you to build a valuable business, you have to understand the market and identify a market that is valuable. So he identified this valuable market, and then he took the bull by the horns, delivered the product, delivered the package. But then later on, obviously decided that he needed to have expansion. I think he introduced other parties in his business through, I think, a franchise model, then had different locations and technology in terms of, the delivery and also the customer interface. So introduction of, leverage in his business as well. And I think the steward is also around leadership, bringing other leaders around you, bringing systems around you. And so when I talk about stewardship, I talk about, so the architect is the one that goes from me doing everything to me designing as the founder now, designing systems, getting, talent involved, and so on, creating, a framework to deliver, an execution framework to deliver. And that's what the investors buy into. So the steward is one that is now essentially developing other leaders. So in other words, initially with the architect, you bring other leaders on board. You maybe have a way to induct them into the business, show them the ropes and so on, and eventually you build other leaders. And now you perhaps going from a more executive role to a non-executive role. In the last chapter of the book, I talk about the founder transition, where, in other words, you're stepping away from the business now and maybe you are doing other things other than the business. Maybe you become an investor, maybe you're getting into philanthropy and so on. So that's ultimately where the steward ends up. He's no longer necessarily actively involved. It may be a non-executive role and something like that. And in Courier Guy case, we see that happening in the space of about 20 years, going from doer to someone that brings structure, brings other partners, bring technology, bring financial partners, and then eventually exits to a private equity investor. And now could be the role, could be a consultant to the private equity investors if something goes wrong in the business. Maybe there was a transition period where he still was involved as the private equity investors now found got to know the business, and so on. And now that gives you opportunity to create another business where you can have, you can diversify somewhere else, and the likes. So I hope I get the point across, but that's really what I mean by this doer, architect, steward transition. Um, and like I say, in the book, in the final chapter of the book, where I talk about how to actually engage with investors and how to actually monetize your business, I have a chapter on that. Then I also deal with the human aspects of what happens after you've sold, and that then talks to the shift from being in the business to being, having other hats that you now wear as the steward.
And I think, Frencel, from my experience, both with this book as well as your previous
Yeah.
book, Wisdom That Builds, and you are very much focused on that building of value, building of business. You're not saying, "Oh, just fix this." You're saying, "Build
Yeah.
this."
Mm-hmm.
But that psychological human element comes across very strongly, because one of the things that I find often with businesses that we work with is they have an idea and they have possibly even a business that is running, and they attach all the value to the idea
Mm-hmm.
and to the business that may be generating revenue,
Yeah.
but not the free cash flow. And one looks and one sees, but there's no leadership depth.
Mm-hmm.
And if you were to lose one or two key employees, the business does not have sustainability. So I would like to explore a little bit of what you've mentioned now with the last chapter in advance, because one of the common misconceptions that people have about funding for businesses is they tend to look for funding when they have a crisis.
Yeah.
We need to fix a cash flow crisis. We reach out for funding at a point where they should have planned for this and had either the free cash flow, the cash reserves,
Mm-hmm.
or the resilience within their funding model to adapt to a crisis. And you speak very clearly.
Yeah.
Chapter 3 is all about that strategic planning. And as
Mm-hmm.
I always do when I read books, and particularly yours, I sit with my cell phone and I photograph the bits that are really they just hit me. And last night when I was reading this and preparing for our interview, and I just read out to my wife who was in the kitchen. I said, stop your podcast, listen to this. Strategy as governance, from setting to sustaining. Strategy is not an event, it is a governance discipline. In many firms, the annual strategy session becomes ceremonial. Presentations are prepared, data is reviewed, and initiatives are proposed. Activity increases, but clarity does not necessarily follow, and clarity alone does not ensure execution. The difference lies in discipline. And I'd like you to take that little piece that I've read out of, I think that's chapter 3. And tied into this concept of what does an investor look at, and the two hats. An investor that is looking at a business in trouble, an investor that is looking at a business that has strategic growth potential. The risk profiles are different. The mindset of the investor are different. The amount of control the founder is likely to retain in each of those situations is completely different. And many people, when they are faced with that psychological impact, do not know how to navigate it. So would you like us to, would you like to look at for us that situation? What is an investor looking for in those two scenarios, and what does the founder need to realize in each of those scenarios? What is the path that leads to it?
Yeah, no, look, so investors obviously look at different things depending on the nature of the investor. So a private equity investor, which is typically someone that invests more in established businesses and looks for maybe certainty of cash flows and so on, would be different from a let's say a venture capital investor that is primarily on growth and technology. But I would say if you look at common things that investors look for, it would be a growth thesis or a growth strategy. And that's also why in part 2 of the book, I have a couple of chapters that talks about the engine of growth. So in there, I talk about strategy, I talk about business model, and I talk about different ways to grow. In other words, you can grow organically, or you can grow by acquisition. So to summarize, one of the points that the investors look for is a compelling growth strategy. Then I would also say they would look for a coherent business model. So you can have a growth strategy, but if your business model, how you can actually execute this strategy is obviously important. Now, tied to those 2 points is the people element. In other words, the leadership, whether it's the founder, and a lot of companies have a lot of successful companies, should I say, have very compelling founders, visionary founders, charismatic founders, and so on. But even so, if you look deeper, all of them have a team around them. So the investor would be looking for, okay, fine, I've got a very competent founder, charismatic, someone that can attract value to the business, can open doors, has new ideas, and so on. And we can think of many famous founders. But ultimately, you're looking for an execution team. And so one of the things I talk about in the book, in chapter 8, I talk about leadership and talent. So I talk about what are the leadership qualities that a founder has to have in this mid-market? What are some of the mental frames that needs to be overcome, to actually have a winning team, So, for example, I talk in chapter 8, I think this might be relevant, of a guy called Steve Walsh, right? Now, Steve Walsh was if I get his name correct, he was the coach for the 49ers, and he took over this team that was completely broken, right? They were at the bottom of the American Football League, and they never won anything. So he spent about a year, 18 months, coming up with what he calls a standard of performance. So there were rules of engagement, how everyone needs to perform. Everyone has a place in the team, but it's about team ethos. It's not about the quarterback being more successful, more important than even the guy who looks after the groundsman. So I thought that those were interesting and important aspects for a founder, a CEO, to embed, to have a standard of performance, to be clear on what it means to win, to be guard against loyalty bias, confirmation bias, to get the best talent on board, to keep them on board, to retain them, to have succession. So an investor would look, as I said, for compelling growth strategy, because obviously you want to create a strategy that's back a team that is winning. Do they have a business model that can generate that value, generate cash, grow the valuation of the business? And do they have a leadership and talent team that can execute on those, the first two, the strategy and the business model? So that's how I would summarize it. I'm happy to continue talking about that, but that's how I see it.
I think, Frencel, you've touched on something that is close to my heart, and I think the use of a team, a sports team, is a very appropriate model, because very often that is one of the greatest constraints of business, is they see their human resource as an expense, not as an asset. And it is an asset. It is generally one of your most significant investments, but it is still seen on the side of the expense side of the statement, and it doesn't appear on the balance sheet. In most cases, it's just not there, unless you've got defined IP. And it is a sad thing to see how many companies, the first place they will cut costs is on that human resource. And yes, from an accounting point of view, it makes sense because it's an easy and quick gain, but it often undercuts the sustainability of the business. And I think one of the things that I really enjoyed reading was the evolution of the business model, which you speak about also in chapter 3, and that need every now and again to sit and say, wait a bit, this is our business model, that's what it was, this is where it is, but to fit in with that strategic plan and that strategic discipline, the long-term vision, this is no longer fit for purpose. And we had a situation this week where I was busy with one of our projects, which is a long-term project. And I was going through the notes, and we have incorporated AI into our business. We have a very strong database that we built up now over the last year and a bit. We don't use AI to interrogate global thinking. We use it to interrogate our own. So we have a strong database that we've built up, and I interrogated it and I said, I think that this is wrong. It's not fit for purpose. Please review the strategy in the light of this knowledge. And we realized that we had to go back to the drawing board, and that takes courage, psychological courage, to admit that your model's not fit for purpose. So I could carry on this conversation for another half an hour. We're actually running now short on time. What I would like to do, Frencel, if you don't mind, is end this session today with a diagnostic that you could give to the listeners and say, okay, here I am in my business. The business is established. I'm in that mid-market. It's a substantial business. we're generating a little bit of free cash flow, maybe not what we need, but we are growing. Our revenue is growing. Even our profitability looks good. But the value is not there. We may have looked at private equity to leverage our growth potential, and we're not attractive. So how does the leadership team, the founder, in a 5-minute synopsis, how do they diagnose whether their constraint is their identity, their strategy, or their business model? And I think this is possibly where we're going to lead with our next conversation.
Okay. All right. So obviously there's quite a lot there. So in the context of what we talked a little bit about the founder constraint and then also the strategy. So what I have in the book, in terms of diagnostics, I have diagnostics for different things in the book, because my thesis or my position is that, the constraint when it comes to the growth of the business, or being able to create something that can continue to grow, can continue to deliver value for you and investors, there may be different areas of constraint. So, for example, I have a diagnostic on strategy, and this diagnostic covers different elements. It covers 6 elements, and I could maybe cover, touch on 2 of them. So the one that I start with is operating in reality. So the external reality, for example. So understanding the market reality. Now, what I often found when I engaged with founders when I was both an executive and then also as a consultant, is there's a lot of defensiveness, right? Is that, look, we've got a great strategy. I remember one instance where one founder wanted to invite, 50 people to the strategy session, and that already is a problem, right? Because what is the point? Who are these people? Why are they coming? What are they contributing? Are they decision makers? Are you focusing on the right things? So operating in reality, because if you're not willing to look at the external market reality, what are the key success factors? What do you need to do well relative to your competition to succeed? If you understand external, competitive environment, industry dynamics, regulatory dynamics, and then say, okay, fine, where do I fit in? What changes do I need to make? And what are the key decisions that I need to make? So that's the one thing. The other one is also, which I cover in the book quite a bit, is what I call addressing a valuable market. And there I bring in the example of Curo, right? So in chapter 3, I speak quite a lot about the Curo business model. So if one looks at Curo, what they did is they realized that, look, you've got the public school system, and then you've got these high-end private schools, right? And they realized that not everybody can afford, the kind of tuition that you have with the, we'll call it Ivy League private schools. But a lot of parents do not want to put their kids in public schools for a number of reasons. But they identified a market that is actually huge and also, addressable. So they identified this market and then identified, how to actually then address this market, which is their value proposition. But I think understanding the market reality and identifying a valuable market, for me, those things are fundamental to building a business that you can sell to a private equity firm. Because if your market is very small, you can be the best in the market, but it's a small market. So how are you going to transcend, unless you do an acquisition or you pivot somewhere else? So in the time that we've left, I would leave those 2 there. My diagnostic does cover all 6 elements. So the way diagnostic work, it essentially covers the 6 elements, and then it allows you to do a self-assessment, and then you have an overall maturity in terms of your strategy setting process. Yeah, but so, and then when it comes to strategy, the other point I would make beyond the diagnostic is also the governance around it. I've touched on it already. Who's in the room? Should they be there? What sort of work did you do beforehand? Coming back to the market reality, because you can't just have a strat session and it's, it's an offsite and, it's a nice year-end thing and so on. And you've got no clear, groundwork that you've laid. Then you also have to have clear priorities. So it can't be free for all. It has to have, what are we here to do? What are the decisions that we're trying to make? And what informs that? Are the right people in the room? And then my other point would also be that, look, it needs to be an ongoing discipline. So once you have the offside, then at your monthly meetings or whenever, you got to reflect back, are we still on track? Do we need to make course adjustments? What has happened? Because otherwise what ends up happening is you do the strat session, you do this document and it goes into a file and, you've had a nice year-end break and so on, but it doesn't mean anything. So those are the things I would leave with the audience.
And I think that what you've just said there ties into something that you and I both believe strongly in, and that is having outside counsel to hold you accountable. We have the expression getting lost in the forest and can't see the wood for the trees, and a whole bunch of other expressions that convey a similar message. But as business people who are involved in business coaching, amongst other things, and strategy advising, we still get outside counsel. We get outside perspective. And one of the things with those kind of situations, particularly with strategy, is have someone to hold you accountable. Have someone to hold your feet to the fire and say, are you still on track? Give me an update. Where are you? And I think on that note, I'm going to just say that I think our previous conversation, we've got a lot to discuss. I'd like to look at those 6 strategic disciplines in detail. I think that's one of the areas I'd like to go because it was a very impactful bit of reading. Your diagnostics in the book are great. Those little reflection at the end of each chapter, you've got that little reflection point. Here's a self-diagnostic. Ask yourself these questions. Are you on track here? As a person who both runs a business and consults to other businesses, it's important for me to sit and have those conversations and be comfortable with uncomfortable answers. To be able to say, hell, I didn't realize I've missed that. I'm wrong. I need to course correct. Can I speak to one of the people that I trust, one of the coaches that I trust to advise me on this matter? It's a very, very important point as well. Frencel, I'm going to say thank you again for this conversation. Thanks for writing this book, because it's giving me, and I know I'm one of the few people that have got to read parts of it, and it's such an important work already. I'm getting value, so much value out of reading it. So thanks for sharing it. Thanks for sharing your valuable time with us. And I'm hoping that this is one of the steps in the journey for founders to transition into growth that builds value. Thanks again.
Thanks so much, Michael.